Welcome to the explainer. You know, in trading, there's a really fine line between having long-term success and having a quick, painful exit from the markets. So today, we're going to break down the single most important rule that decides which side of that line you land on.
So let's just get right to the heart of it with a question you really got to ask yourself. When you put your money on the line, are you actually trading or are you just gambling? And look, the source material on this is super direct. It draws a crystal clear line in the sand. If you ignore this one principle we're about to talk about, you aren't trading, you're gambling, period.
Okay, so what is it? What's that one thing that truly separates the professionals from the amateurs? I'll give you a hint. It's not some secret stock tip or a fancy algorithm. It's a disciplined approach to risk that turns random bets into a real, sustainable strategy. This brings us to your ultimate safety net. We're about to introduce the most important rule in all of trading, the one principle that's specifically designed to protect your money so you can survive and thrive in the market long term. And it all comes down to this one little number, 1%. It seems so small, right? Almost insignificant. But I'm telling you, its power to preserve your trading career is absolutely immense. This is it, the 1% rule. And you've got to understand this isn't a suggestion. It is a hard and fast, non-negotiable rule. It means that no matter how amazing a trade looks, no matter how confident you are, you will never risk more than 1% of your total trading capital on that single idea, ever. So how does this actually play out? Well, let's say you have a $5,000 account. Your max loss on any given trade is just $50. If you have a $10,000 account, it's $100. You see, the beauty is that your risk stays perfectly proportional, protecting you no matter how big your account gets. Here's a great way to think about it. The 1% rule is basically armor for your trading account. It's a mathematical shield that makes a catastrophic, account-destroying loss, well, pretty much impossible. And let's see that armor in action. Just imagine you hit a brutal losing streak. We're talking 10 bad trades in a row. It happens. With the 1% rule, you're only down about 10% of your capital. Yeah, that stings, but it's a setback you can totally recover from. Without that rule, just one or two of those trades could have wiped you out completely. Okay, so knowing the rule is one thing, but how do you actually enforce it mechanically without letting emotions like fear or greed get in the way? You need a tool. You need an automatic eject button. And that tool is called a stop loss. It's really simple. It's an automatic order you place with your broker. You just decide on a price beforehand, and if the stock happens to fall to that level, boom, your position is sold automatically. There's no hesitation, no second guessing, no hoping it'll bounce back. Think of it exactly like the eject button in a fighter jet. You decide where it goes before you even take off, before you enter the trade. That way, it's not you in a panic making a bad call. It's the calm, rational you from earlier executing a plan, taking all that emotion out of the equation. Okay, this is where it all comes together. We're going to combine the 1% rule with the stop loss and show you how a little bit of simple math can protect your capital and tell you exactly how to enter a trade. And this brings us to what is maybe the most crucial question in trading. How many shares should I buy? The answer should never, ever be a random guess. It's a precise calculation, and it's called your position size. And here's the formula that ties everything together. Your position size is simply your maximum dollar risk, that's your 1%, divided by your risk on a single share. And the risk per share? That's just the distance between where you buy and where your stop loss is. That's it. All right, let's make this super clear with a real-world example, because that's the best way to get it. Let's say you have a $10,000 account. You're looking to buy stock XYZ at $50 a share, and you've decided that if it drops down to $48, your trade idea was wrong and you want out. So let's just walk through the 3 steps. Step 1, what's your max risk in dollars? Well, it's 1% of 10 grand, which is $100. Easy. Step 2, what's your risk per share? That's just your entry of $50 minus your stop of $48, so $2. And finally, step 3, you just divide your max risk, $100, by your risk per share, $2. And what do you get? 50 shares. And there's the magic. The result is you buy exactly 50 shares. Not 100, not 20, 50. Now, if the trade goes south and hits your $48 stop loss, you lose $2 per share.
And what's 50 times 2? Exactly $100. You lose precisely the 1% you plan to risk. Your loss is perfectly contained.
So what you have now is a professional trading framework. It's a simple 3-part checklist for every single trade you ever make. Number 1, always risk only 1% of your capital. Number 2, always use a stop-loss order. And number 3, always calculate your position size before you hit the buy button. No exceptions. Once you truly get this process, everything changes. You're not gambling on whether a stock goes up or down anymore. You are professionally managing risk. See, you can't control if a trade is a winner or a loser, but with this, you have absolute control over how much you lose when you're wrong. Your risk is now managed. So the only question left is, what's your next move?